Global markets and Fed Chair Powell shrug off stronger US producer prices ahead of key CPI data tonight. Australia's budget goes from surplus to larger deficits as cost of living policies help ease inflation. UK wages are stronger and New Zealand's housing market continues to struggle. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview ahead of those CPI figures, ANZ's head of G3 Economics, Brian Martin, explains why the world's major central banks are diverging in their monetary policy cycles.
All these central banks have their own mandates. They are all independently focused on delivering on their inflation targets and on their growth optimization as a result of that.
But first, in 5 and 5 with ANZ. In global market, stocks and US Treasury yields were holding steady ahead of US CPI data for April out tonight. Producer prices in the United States rose 0.5% in April. That was above expectations, but the market reaction was tempered by US Federal Reserve Chair Jerome Powell saying he didn't think the data was that hot. Powell, who was speaking in Amsterdam, also reiterated the Fed may need to keep rates high for longer, but said he didn't think they would need to go up again. US Treasury yields were trading down 2 to 3 basis points at 5 a.m. Sydney-Melbourne time, and the S&P 500 was flat. The Aussie dollar up 0.2% at 66.2 US cents, while the Kiwi was up 0.35% at 60.35 US cents. Attention turns now to that CPI data in the United States tonight. ANZ head of G3 Economics, Brian Martin, is expecting monthly headline CPI of 0.5% in April from March, but says the more important core CPI should ease slightly to 0.3%.
We think that the increase in the March CPI owed largely to one-off factors in a narrow sector of goods. And we think that that's unlikely to be repeated to the extent that it was last month, and therefore that the CPI should be a bit lower. In fact, I thought it was interesting that Chair Powell in his comments overnight said that he does expect the monthly CPI to start to ease.
Number 2, Australia's federal budget last night showed a near-term improvement in its finances, with a surplus of $9.3 billion forecast for the 2023-24 year. But the Treasury forecasts a deterioration after that, with larger deficits out to 27-28 due to higher spending. Here's ANZ Head of Australian Economics, Adam Boyton, last night from Canberra.
New spending in 2024-25 comes to around $10 billion, which is what we're expecting. So what that means then is that there's no immediate impact to our inflation, our growth, or our expectations for the RBA coming out of this budget. There are a range of policy measures in the budget. Probably the one that will get the most attention is every household receives a $300 electricity rebate. But there's also a lot of other initiatives contained in the budget, including $22.7 billion over a decade to help fund the future Made in Australia package.
Number 3, Adam says the Treasury has forecast that cost of living measures in the budget will help keep inflation down.
They're expecting inflation will come back to 2.75% by the time we get to the June quarter 2025. That inflation forecast will include and does include the impact of some of the cost of living relief measures in the budget, which will work to directly lower inflation over the coming 12 months. Indeed, Treasury estimates that these measures will directly lower inflation by 0.5 percentage point. Of course, it's possible that putting some money back in consumers' hands could add to demand, but that will play out, if it happens, very slowly and over a much longer period of time.
Number 4, in the UK overnight, wages grew slightly more than expected at 5.7% in the 3 months to March from a year ago. The unemployment rate, though, ticked up to 4.3%. Brian says while the labour market is weakening, there's still enough to catch the Bank of England's eye.
I think the Bank of England is going to watch the path of wage growth over the next few months before cutting interest rates. But my sense is, based on the data that we did have overnight, that pushes the skew for when the Bank of England will have confidence to begin cutting interest rates more towards August rather than June.
Number 5, New Zealand's housing market remained sluggish in April. ANZ senior economist Miles Workman says seasonally adjusted house prices rose only 0.1% in the month. Sales rose, but were subdued, and the number of days to sell rose as well. Inventories keep climbing.
There's more and more stock on the market, despite the fact that sales are rising. And in fact, when you take that ratio, sales to listings, that gives us a good indication of how tight the market is and can give us some signal on forward-looking price momentum. And that signal right now is suggesting that prices are certainly going to struggle to grow at a rapid pace anytime soon.
Miles Workman there. Now, on our bonus deep dive interview, ANZ Head of G3 Economics Brian Martin looks at how the prospects for rate cuts by the world's major central banks have been diverging, particularly as growth holds up in the United States.
I think it's noteworthy that central bank officials, and at very, very senior levels, from Lagarde at the ECB, the number 2 at the ECB, the Bank of England Governor, Mr. Bailey, they've all been saying our monetary policy is not Fed dependent. We will move independently of the Federal Reserve. And I think that's absolutely the correct thing to do. All these central banks have their own mandates. They are all independently focused on delivering on their inflation targets and on their growth optimization as a result of that. And they must do what is appropriate for the countries that they are responsible for.
And it's not always in one direction at different times. There is one central bank which may go in the other direction. Could you tell us about the Bank of Japan?
We've penciled in June for the ECB, August for the Bank of England, but if the data really improves in the next couple of rounds of data that we have, June is going to be live for a rate cut from the Bank of England. By contrast, in Japan, the Bank of Japan's bias is to tighten monetary policy further. They moved away from negative interest rates in March. The yen has been under significant pressure, which is going to add to import price inflation over time. Now, I don't think yen weakness in and of itself will be sufficient to trigger the Bank of Japan to raise interest rates in the future. I think what's going to drive them to raise rates is the fact that wages are higher, firms' pricing power expectations have recovered, inflation expectations amongst households and amongst other various different age sectors within the economy have recovered. And I think once they get confident that they are going to meet their 2% inflation target sustainably, the Bank of Japan will be raising interest rates again. Now, they're not going to be racing away with rate hikes, but I would fully anticipate that in a few months' time, we could be looking at the BOJ coming into a position where it may have to consider raising rates again, subject to the inflation data confirming the path that they expect to be on.
Just looking at the fundamentals behind this divergence, why is the United States economy more heated?
First of all, you've had a very large rise in net migration over the past year. It's expected to continue this year and indeed into 2025. So you've had net migration of 3.3 million last year, expected to be the same this year, and forecasts of 2.5 million for 2025. So that huge influx of people is adding to demand. Secondly, you've had a hugely expansionary fiscal policy in the United States. Not only was the government very generous in supporting households during the COVID lockdowns and supporting businesses during the COVID lockdowns, but we've had President Biden's Build Back Better campaign, we've had the Infrastructure Act, we've had the Inflation Reduction Act, which puts an awful lot of money into the climate sector. And I think that fiscal expansion coupled with the population growth are really key drivers of what is keeping the US economy buoyant at the moment. And that therefore means that it is probably a bit more difficult for the FOMC to get inflation sustainably to target, or to just take that bit longer than it is in other economies.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, May the 15th. Catch you tomorrow with those US CPI numbers and what it means for interest rates around the world. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.